Today on Escape the Clock, we're aiming to answer the question, what if you bought the asset, watched the money come in, and still could not afford to quit your job? Most people who leave work believe they got the timing right. In a 2026 AARP survey, 68% of retirees said that they left at the right moment, but nearly 3 in 10, 28%, said that they left too early. And among retirees who went back to work in the past 6 months, 48% went back because they needed the money. These are not people who never got to leave. These are people who left and then had to come back. And that is not a math error. That is a cash flow error. Because owning something valuable and getting paid by it are two very different things. Today's guest learned that the hard way. Tim Woodbridge spent more than 8 years as a registered nurse. At the end of 2019, he bought a small, distressed mobile home park, and he brought about $6,300 of his own money to the table to do it. He kept the job. He bought another park, and then he quit. And not long after, he was filling out nursing applications again, with 3 parks in his name and 4 more under contract. Nothing was wrong with the parks. Something was wrong with his paycheck. Now he is a full-time operator and the founder of WCG Investments. So today we get into how he got into a $250,000 asset for only the price of a used car, and why owning 3 of them still did not cover his bills, and then the structural fix that finally let him quit for good. Welcome back to Escape the Clock, the show where we highlight strategies and approaches for achieving financial freedom and having the option not to work. I'm your host, Daniel C. Rogers. Growing up, you may have been taught this simple advice. Earn a paycheck, spend less than you make, and put the difference into an account and wait for a few decades for it to grow. It's good advice, but it misses one important risk. What if the assets don't actually grow? And there are many factors that can get in the way. The market, the economy, theft, or even our own behaviors. And that risk can make all the difference between success and failure, especially when so many put all their eggs in one basket. Nearly all of America's wealth lives in just 2 places. As of a 2025 Federal Reserve report, citizens owned corporate stock worth more than $61 trillion and real estate more than $49 trillion. Those 2 assets dwarf everything else families own. And owning properties and shares of stock, it is one of the easiest paths towards wealth. But the catch is that the value of these things are set by what everyone else is willing to pay. And most just wait, hoping time will do the appreciation they need to meet their goals. But there is another common path to wealth, and it is the type of asset that accepts a more hands-on approach. You may have met someone who made it big doing this. Instead of just working hard and saving and investing, they might have built or bought an income-producing business, or even sold one for a massive payday. And it's a dream for many, but one that can sometimes feel just like that, a dream. But what if there was a path that made this manageable for the rest of us? A way to own a business like that without having to build it all from scratch. Today's guest has achieved that dream for himself, and now he spends his time trying to help others do the same. Tim Woodbridge was a registered nurse for more than 8 years before he left the hospital floor to build a portfolio of mobile home park communities across the country, starting with a single distressed park back in 2019, and then scaling deal by deal. He is now a full-time operator and the founder and managing member of WCG Investments. Tim, welcome to Escape the Clock.
Thank you so much for having me on, Daniel. How's it going?
Great. I know you don't have the typical background that a lot of people think of as someone who is teaching people the path to financial independence, but either did I. So here we are. You were a registered nurse, and I know you were really grinding it away there. I heard your story before, and so I would love for you to share that with the audience a bit here. So maybe you can take us back a bit and talk a little bit about nursing and what that taught you and some of your struggles then, and then how that got you into what you're doing today.
Yeah, it's very similar to a lot of what you were saying earlier is what everyone's taught. I was taught the same. Get a good job that's stable, that's going to pay me well. And yeah, just work hard and then retire in your 60s. Pretty much everyone hears the same thing. And so, yeah, I went into nursing because I like it. I like human biology. I like people. It's fascinating. Medicine's fascinating. And so, yeah, I did it. And I remember graduated from nursing school, did the job, and I was like, oh, like this is great, but is this it sort of feeling? And yeah, Yeah, I found real estate, said, okay, this is kind of how a lot of people are building wealth. I didn't really know anything in terms of what that would look like. A lot of people that were in like my position could have, went and bought a business, a cash flowing business, got out of their job or anything. I didn't really have a plan other than I know if I buy this, it'll be worth more in the future and it will put me in a better place than I was back when I was a nurse. And yeah, long story short, bought that park. I've scaled it to 25 parks, a little over 1,100 pads, and the similar stuff that you do with any kind of business.
As you were talking about that, it was reminding me of people I've spoken to so many times now who they have a job. They worry though that they're not doing something bigger than their job. Like, you were doing nursing, but, I've met people across all different industries and they worry about things like layoffs. They worry that, their job's not going to be enough to meet their financial goals. And usually when I ask, well, what types of moves are you worried you're not making? So many of them do mention, oh, I should get into real estate. It comes up so often and everyone kind of invests now, but usually it's because of an employer, kind of 401k or things like that. I'm kind of curious what drove you towards real estate personally, because I know you were educating yourself. I think I remember you mentioning like you had caught like bigger pockets or something and you were learning and teaching yourself. Why did you decide to actually make the move on real estate? Because I know a lot of people are kind of scared to do that.
Good question. First, yeah, it's scary and like scary is okay. Scary shouldn't be I'm not going to do it sort of thing is what I've learned. But I read Rich Dad Poor Dad and I was like, oh, this is how people get rich. And I didn't know, like my dad is blue collar and, we did well as kids, but the whole like idea of being rich it was just like out there. It's like, oh man, look at all these people affording all this stuff. I wish I could do that someday. And then just reading the book and being like, oh, this is how they do it, made it a little bit more concrete. It's like they own assets, at the heart of it. Yeah, I was like, okay, this is going to put me into a place where I'm better off. I'm more wealthy. I'm more rich. I'm more whatever, I was just drawn into it by the allure of this is going to get me rich.
That's, I think, what most people are thinking, right? Like, I need to get richer so I get some of my freedom back. And you mentioned assets, and I think that's really important because I think anyone who's not thinking about this as much, I think a lot of it is just, I get paychecks, right? Cash coming in and, am I getting ahead or not? Where's that money going? But building up a portfolio is everything. And it is scary. There's a lot of fear there. There was this U.S. Bureau of Labor Statistics report that said that 1 in 5 new businesses fail in their first year and roughly half are gone within 5 years. So people might see that like, wow, it's so easy to fail. It takes capital to get going. And there's a lot of talking yourself away from making the move. Why did you ultimately decide, though, to take the leap for yourself?
I don't want to get older and look back at all these regrets in my life. At the end of the day, I'm like, okay, I know if I don't do this, I'm going to regret it. And so I took the leap. But I will say I'm in real estate and real estate is probably safer than businesses. Like businesses, there's a lot more potential upside and there's a lot heavier cash flow, but they can go to zero. Whereas the real estate, unless I'm being really dumb and making it so I'm not making my mortgage payments, still probably not going to go to zero.
I know for me, like it always helps to know that I've kind of earmarked funds that I feel like, okay, this is something that has a good chance of paying off, but if it doesn't, it's not going to crush me.
Yes.
That's gone.
Yes.
Yeah.
I bought real estate, but I still had a job. I still worked as a nurse 3 days a week. I made time for something that I thought was important and it really paid off. And I think even if it didn't, even if I got into mobile home parks and I was like, no, I hate this. This isn't for me. I think taking that leap and taking the scary steps that led me into that first mobile home park, that would have showed me, oh, okay, I can do this. I don't have to do what everyone's doing. I can do something that's a little bit different, that's a little exciting.
What's the timeline like for that for you? Like, when did you make the first investment? You mentioned you were still working at the time. When did it start to really pay off for you? And when did you finally decide to just leave nursing altogether?
Yeah, so I left nursing earlier than I should have. So let's see, I bought my first park, and then 2 years later, I got into my second park. Maybe 6 months after that, I left nursing, and I didn't have replacement cash flow. I just had like a nice bit of money in my savings account My last nursing job was the only nursing job that I really didn't like, and which was a blessing because I was like, oh, well, I've got some real estate. Let's see if I can figure this out, And so I quit. Worst comes to worst, I can go get another nursing job.
Yeah, sometimes you got to put your own back to the wall to dig in.
Yes, yes. And I almost did, though. I was applying for nursing jobs before I got like a big break, if you will. And my big break was, oh, well, I like mobile home parks, but I need to pay myself consistently from these. I had 3 at that time as I'm applying for nursing jobs and 4 more under contract. And it's like, okay, well, I should take one acquisition fee and I should take regular property management fees because I am doing the work. I just wasn't taking the money to pay myself. And so it's, just structuring things a little bit differently.
Oh yeah, you did something important, right? You did something that we talk about on the show a lot, which is build a paycheck. Like if you don't build a paycheck, how are you going to stop working your main job?
Worst comes to worst, I could have gotten a job again. You'll figure something out because people are resilient. At the end of the day, people figure things out. I think they just let their fear make it so they think that they can't.
Yeah, plus the day job can distract us. Sometimes I think people think they need to build to get into real estate. You bought though, and you didn't go for like big complexes or multifamily homes or things like that. You went into park communities. Can you talk a little bit about why you decided to buy in and why into that type of community?
Yeah, so read books and listen to podcasts, listen to Bigger Pockets like a lot of people. And, Brandon Turner's talking to Frank Rolfe about mobile home parks. And I was like, oh, I didn't know that was a thing. Okay, I'm kind of excited about that. You got sticky tenants, you got lower expense ratios, and it was just a little bit different than kind of what everyone was going after. And so because of those 3 things, I was really excited about it. And I followed my excitement. And there's nothing like other than, man, I was kind of excited about it. And because I was excited, I learned more and I did more research. And I said, okay, how can I do that? Because I don't have all this money. I can't buy all these things. How can I do it though? How can I get involved? And that led me down the rabbit hole that I am still in today. Okay, how do I buy bigger properties? How can we raise from different kinds of investors that'll make it so our big goal of buying 250 million mobile home parks by end of 2028, how do we make that work?
It's like the business case kind of made sense to you as you were learning about it. You saw the opportunity, but most importantly, it tapped into your passion, right? Because you need that. That's your fuel to keep going, even when things get hard. It sounds like you figured things out early enough that you're able to kind of start scaling. And now you have like a real business here. And that's really amazing. Can you talk about some of the earlier days first, about maybe some of the things you may have had wide eyes for, and then maybe the humbling moments of like, okay, wait, wow, that was actually not exactly what I thought it was going to be, or it was a little bit more challenging than I thought?
When I quit nursing, it's like, oh, I've got money, like I'm doing good, but like not having that paycheck coming in every 2 weeks freaked me out. And so I got into single family wholesaling, spending money on marketing and VAs and making a big business out of something that I shouldn't have. And what I've learned is that so I was really focused on how much money I can make. And that was the only thing I was excited about. I wasn't excited about the process or anything like that. And I crashed and burned. And so, yeah, what I've learned is if I'm only going after money, it's not the right opportunity. There's a ton of people who do great with that. I didn't. I lost a lot of money. I've been in an apartment. I'm not really crazy about like traditional multifamily apartments. I have a smaller RV park. I don't really like that asset class, like a transient RV park. So I've tried it. I've tried different things that I'm like, yeah, this is great. And then I've learned the grass isn't greener at all. Like everything has its problems. It just so happens that I like the mobile home park problems. I like figuring those ones out more than I like the other ones.
Some of what you were saying there was making me think of this idea of knowing how much of your investment you want to put in, not just money investment, but your time investment, because, you can passively invest. Like if I were to just use the stock market for a moment, since I do a lot there, you can be a passive investor. You could put some capital into like a passive index fund, just let it grow. Don't think about it. You have diversification built in, things like that. Or you could be more of an active investor and you could try to do swing trading. You can try to do options trading. You can get really, really involved, but you have to do the research, because if you don't do the research, you will make bad trades and then you'll pay for it. And then you'll be forced to learn the hard way instead of the good way. It sounds like you were kind of doing that, but in the real estate asset classes, which is really interesting. So what in particular about where you landed is so exciting to you? Is it like you just said, it just happens to be your personal preferences, or there's some kind of particular problems in those other ones you're like, that's just not worth the headache?
Yeah, basically just not worth the headache. I like low and slow and consistent. I don't like the turnover that the apartment had or the transient RV park. I like when people come in and when they can get a nice, affordable place to live. We can make the place nicer, through new roads and stuff like that. I got into it because I really like the stability, but the more I do it, the more I realize that we're able to do a meaningful impact on people who need these lower rent parks that we have. It's doing a little bit of good in the world.
Nurses' paychecks aren't a fortune. Like, just be honest, and you lived it. So how did you pay for your first deal? Were you actually using leverage? Were you borrowing money? Did you budget for it? Like, how did you get going?
You're right. I didn't have the money. And I remember hitting $10,000 in savings and be like, holy shit, I'm rich. But yeah, so the first deal, I found it was for sale by owner. Negotiated the price, but it was a smaller purchase price, $250,000. I didn't have any kind of down payment, again, other than that $10,000 that I felt good about. And so I partnered with someone who I already had a pre-existing relationship with. We got a bank. So yes, we levered it with a bank loan. So a 70% bank loan. I got a little creative and the seller carried 50,000 interest only for a year, needed to bring 25,000 plus closing costs. So my partner brought the 25,000. I brought the closing costs, which was like $6,200 to $6,300. And then we closed it. If I was smarter back then, like I am now, I would have had reserves and stuff like that. But nope, nothing like that. But, we figured it out. I've learned things along the way.
Yeah, it's like the first kid, you're like, wow, it's harder than I think. I made some mistakes, but I'm going to do better on the next one. But then you realize as you scaling is its own problem.
Yeah. And my partner, Matthias, he likes to see what breaks as we're scaling. Like, okay, these are the things that we really need to fix and pay attention to so we can keep scaling.
He sounds like a project manager, which is great. I mean, that's what I did before I retired. And you do have to really look and stress test things and think about, okay, this might work now, but is it going to work with 10 more units? Is it going to work in this other market condition? Can you talk a little bit about how you've matured in the way that you're scaling your deals? And I know you have a main partner, but how much now do you change the way that you fund some of these things? And how are you thinking about the operations?
I don't think about the operations as much as I used to because Matthias is our COO and is way, way better than I ever was. And a lot of what I do now is letting people who are better at what they do take charge and taking more of a supportive backseat role. I was in buying mobile home parks through creative structures, JVing, joint ventures, more simple stuff for the first 4 years. And then 4 years into it, the first deal that Matthias and I partner with together is the first deal that we raise capital for. What's interesting with raising capital, it's very similar to marketing and sales in a traditional business because, I'm simple. I just want to buy all the mobile home parks. And how do I do it? I get great returns for everyone involved, and I keep looking for people who might have a need for, monthly cash flow and great tax savings and all that fun stuff, and that our mobile home park investments get to people. So we do things low and slow.
Yeah, I think the dream of building a business is knowing that at some point you have grown it to the point where you can't possibly do everything. You got to trust others to help you run the thing. I mean, that's success in a way. I do think one thing we all have in common, though, is we all care about returns. I think that's the point here. And now that you focus on that, how do you go in and kind of figure out ROI? Well, I mean, are there certain opportunity zones you're looking for? Are you looking for underperforming areas that you think you can kind of flip and turn around? Or are you looking at certain cap rates or other things that you think, oh, those are going to be strong leading indicators that are going to always get the kind of return I need for my investors? What have you kind of learned is have the bigger payoffs?
The answer, just like in nursing school, is it depends. Every deal that we're looking at, it's all like based on a 5 to 7 year business plan. When we're looking at things, when we're analyzing it, first of all, does it fit what we're looking for? And we buy in the Southeast, and we do very well in the Southeast. We're looking for a minimum pad size. We don't buy this, and this. And so as long as it passes the sniff test, then we'll do a full underwriting of it. And then in there, that's when you can really find what are the little levers we can pull to make these returns. So, I'm not looking at, hey, if I buy this at a 10 cap, I can make it into a 7 cap. It's more like, what's the purchase price I need to buy this at? And what are the little levers we can pull? Because sometimes it's under market rent, or sometimes, there's a value add, or sometimes there's something that no one's seeing, or sometimes we can reduce expenses. And so, that's why I'm like, it depends on the deal. But no matter all that stuff, there's always a price that makes sense. It's usually not the seller's price, but it's a price that I can say, here's our offer and here's why. And I can defend it because, hey, we need to get these returns for investors in a reasonable way to actually raise the money to close the deal. And so here's the offer. And then I hear no all the time, 9 times out of 10, if not more. I hear no in that first pass. And I just follow up, man.
With the nursing background, I guess I was kind of curious how you got your business acumen for some of that. And I know you have the team helping you there.
I don't know. I surround myself with people who are ahead of me. And so reading and being around people and being in masterminds. I met Matthias and my other partner, Vinny, in a multifamily mastermind that was all about multifamily and raising money and stuff like that. And so seeing what other people were doing and then being in groups, now I know something about this. And it's just, there's so many things that you don't know until you really get into it and get curious about it.
I mean, that's one of the things I love most about just putting yourself out into an area like this is just the growth that you go through, all the new skills you learn, which can translate to so many areas of our lives. And it's kind of amazing. And then if you do well, you afford the time to keep investing in those skills and growing them and mastering them. I think it's so amazing. I am curious how the market looks today versus when you first came into it. Like if you were starting today, do you think you would have been as successful? Because I imagine there's some new challenges now than, back when you started.
I bought my first one at the end of 2019. Looking back, a good time to buy. But then, COVID happened and everyone's buying at crazy prices because your debt is super cheap. You're getting a 3% interest rate. And so, people were buying at higher prices because you could. The numbers made sense based on all the variables you had then. Yeah, was it easy to buy then? I mean, it depends. It depends on who you ask. Is it easy to buy today? I think so. Granted, I'm a lot better today than I was, so it's easier for me. But also, I see opportunities. I had someone send me an opportunity for like a 16-pad park that was like, I don't know, $400,000. And it's like, it passes the sniff test. Like if I was newer, I'd look into it. I think the question, like, is it easy, is maybe not the right question. I think, like, is it doable? And I'd say, yeah, if I can do it, you can do it. I'm not any smarter or better. I just take action. That's it.
At this point, where are you with things? How do you feel about your life today versus how your life was back when you were doing nursing? Do you feel like you've accomplished most of your goals, or has this kind of created new goals for yourself?
Always new goals. I had a coach who told me your life is always going to be couch to castles. So meaning you're on the couch, you're looking, oh man, I wish I could do that. And then you walk up and you do all the things and you're in the castle and the castle becomes your couch into the next thing. And I'm always curious and always enjoy moving forward. My wife and I just went to the Outer Banks, North Carolina. We did some due diligence on a park that we're about to get under contract. So we did the work that we wanted to do, and then we stayed like through the weekend. So we stayed another 3 days just to explore. Yeah, that's the stuff that I really, really enjoy. And I get to do it with Jen, and so lucky and so thankful and so grateful that I can lead the life that I have today. So it's beyond my wildest dreams, man. It's crazy.
Love that. And congrats on making the big moves and actually building those assets that can really create that life that you're looking for. So, Tim, how can listeners connect with you and how can they learn more about WCG Investments?
Yeah, so y'all can go to WCGinvestments.com, kind of see what we're doing, and you can book a call with us. We can talk about, what investing with us would look like, and even like if it's the right move. So yeah, we're always down to talk with people and see if we can help. It's either you're passive, you just want to put money into something. If you're thinking active and you're like, hey man, mobile home park sounds like an interesting path, shoot me an email. I created like a free course. I'll send it to you, tim@wcginvestments.com. And yeah, just say that you're looking to get involved and be an active operator and see if that's for you. And I'll send it to you. I'm just looking to help basically myself 6 years ago. So if I can provide any value, that's what I'm here for.
Well, thanks again, Tim, for coming on the show. I appreciate your time.
Thank you so much.
We're told to buy assets, to own things, to build that portfolio. And it's good advice. I personally wouldn't have made it to my early retirement goal without it. But somewhere along the way, we started treating ownership as the finish line, as if the moment you own enough, the job will just fall away on its own. It can, but that isn't guaranteed. Building that escape hatch can be a risky proposition. How do you even know which path to take? I was there myself. I was running a 20-year program to retire early at 45. I knew I needed to funnel my cash flow somewhere, but where? I could have saved up and started a business, but that just sounded like a new job to me. I could have started buying properties, but I had multiple mortgages and I was struggling just with my own home. So I decided to focus on the stock market. It was something I could funnel money into over time and let it do the work without any real asset calling me at 2 a.m. Still, that money didn't feel real. My net worth was ticking higher, but it was that paycheck from work that I still live by. Money showed up every 2 weeks. It was predictable. It was comfortable. And I could plan on paying my bills and paying down my credit card debt and saving for a trip. It's an easy rhythm to fall into. And my employers helped grease those rails. They never missed sending me a paycheck. They promised bonuses. They automatically put money in a 401k before I ever saw it. Taxes were withheld for me. My health insurance premium was deducted before the deposit hit. Somebody I never met in a department I never visited made all of that happen on time, every time, for 2 decades. That is not a paycheck, that's actually an infrastructure. And I did not build a single piece of that. It might not surprise anyone to hear that places like Google offer free meals, gyms, and even things like massage services. The employers incentivize you to keep you at work, at least until they feel it's in their best interest to let you go rather than continue to pay you. In a way, my timing was serendipitous. I retired early at 43, 2 years ahead of my goal, and since then, literally dozens of my friends and ex-coworkers have been laid off from the tech industry. All of their hard work and loyalty rewarded with just a few months of severance. It can be scary to finally leave work. Some even quit too soon. Even if you quit right, there are things that nag at you, trying to tell you, hey, maybe it'd be better just to go back to some of those comforts you had before. In that first month, while all the sleep was wonderful, I had to get used to the idea that no one was withholding anything for me. I was now responsible for everything myself. Taxes, deposits, cash flow. There was no department. I was the department. But I never did go back to work. If anything, I've mastered the quote-unquote early retirement life. And others do as well. Here's what actually saved me. I didn't leave until my passive income covered close to 100% of my cost of living. I paid off the mortgage 2 years before I walked. I had no debts. I budgeted for my own insurance. And most importantly, I knew exactly where the money was going to come from each month. All of that provided psychological safety, especially when those golden handcuffs finally fell off. And it wasn't luck. It was a plan. Tim did it the other order. And he'll tell you that himself. He said it plainly. I left nursing earlier than I should have. Listen to what actually happened there, because it's the most useful thing in this episode. First, he bought his first mobile park home at the end of 2019. Then he got a second. Then he quit nursing with no replacement cash flow, just with about $10,000 in his savings account. And before he knew it, he was filling out nursing applications again, with 3 parks in his name and 4 more under contract. 3 income-producing properties, 4 more coming. Sounds like a massive success. Yet he was there updating his resume. The parks were fine. The parks were working. The problem was that none of the money was actually reaching him at that point. Now, if you've never owned an operating asset, this might sound impossible. So let me explain it a bit in a way that I wish someone had explained it to me. So when the rent comes into a property, it doesn't actually come to you. It goes to the mortgage first, then the property taxes, then insurance, then repairs, then the roads, the water lines, and whatever else broke that month. Then reserves for the things that are going to break next month. If you have partners or investors, their returns actually come before yours, and whatever survives all of that usually gets rolled into the next deal, because the next deal is how you actually grow. So the property can be performing beautifully, and your personal bank account can see none of it. The asset was never refusing to pay him. He had simply not built the part where he got paid. And the fix, when it came, was almost boring. Tim realized he should take an acquisition fee for the work of finding, underwriting, and closing a deal, and then the ongoing property management fees for the work of actually running the thing. He found a way to create liquid cash flow into his bank account. He was already doing all that work, he just hadn't been charging for it. That's it. That is the whole break. He stopped treating his own labor as free and started routing money to himself on purpose. That might sound like a niche real estate problem to you, but I promise you it's not. Bluevine surveyed small business owners and found that 62% had reduced or skipped their own pay at least once in the past year to cover business costs. For 21%, it happened 4 or more times. When the business needs cash, the owner's pay is the first thing to go. So is yours. Think about the last time money got tight in your household. What got cut? Not the mortgage, not the car payment, not the utilities. You cut the transfer to savings, you cut the investment contribution, or you cut the thing paying your future self because it was the only line item that would not call you and complain about it. Every one of us runs the same play that Tim ran. We pay everyone else first and call whatever is left over a quote unquote plan. So let me reframe what this episode is really about. Quitting too soon has almost nothing to do with the calendar. It has almost nothing to do with your age or the market or whether you feel brave that morning. Quitting too soon means quitting before the mechanism that pays you exists. You do not quit on a balance, you quit on the payment. If I had quit because my net worth had hit some target number, I could have celebrated and then found myself going right back to work within 6 to 12 months. Luckily, I understood the power of payment, and thanks to my dividends, stock premiums, high yield interest, and now rental income, I know I'm free of that employer's promise of pay. Let me say it another way. A number in a brokerage account is not a paycheck. It's potential. A property with equity is not a paycheck. It is potential. A business that is profitable on paper is not a paycheck. It is potential. A paycheck is money that arrives on a date that you can predict in an amount that you can spend. So ask yourself this. If you handed in your notice tomorrow, what pays you on the first of the next month? If you can't answer that sentence, then you don't have a date yet. Now the good news. Escape the Clock is about building a program that helps you get to the real goal with confidence. Building that paycheck is just a project, like any other. It has requirements. You have a goal to achieve, a set of tasks to move the needle, and a milestone to celebrate when the work is done. And you might be wondering, how do I even plan something like that? Well, consider there are actually 4 aspects of any income stream. First is it scheduled? Dividends have pay dates. Bond and treasury interest has pay dates. Rent is due on the 1st. A stock or property you might sell someday, but it has no date at all. Second, is it sufficient? This is where you have to know your early retirement cost of living, not your current one. You're not replacing your salary. You're actually just trying to cover your costs in this new life of yours. And so these numbers can be wildly different. And the gap between them is years of your life. I provide the calculation in the book. So if you haven't done it, consider that the very first task. Third, is it durable? Can it survive a bad year? Mitigations are key here. If my dividend gets cut, I still have hedges that will continue to pay me. If those go away, I have cash reserves to ride for a while. Where people get themselves in trouble is that once the cash starts flowing, they think they're done. But tenants leave, dividends change, and rates drop. Tim said something that I want you to think about here. He said, if I was smarter back then, like I am now, I would have had reserves. Reserves can give you the peace of mind to weather any storm. And he's right. And the data says most of us are not ready. Only 63% of US adults say they could cover an unexpected $400 expense using cash. Finally, the fourth aspect. Is it separable from you? This is the one that I think people miss. If the income stops the moment you stop working, you didn't buy freedom. You just bought a different job with different branding. The cash should flow without you passively. They call it passive income for a reason. So run your streams through these 4 tests: scheduled, sufficient, durable, separable. The ones that pass are your paycheck. The ones that fail are still potential, and potential doesn't pay next month's rent. Then you stack them, and you stack them deliberately. Interest from high yield savings and treasuries, those can go at the top. Dividends from shares you already own. Rent, if real estate is your thing. Covered calls, if you've learned that machine. Royalties. Distributions or a management fee from a business you operate, which is exactly the door that Tim ended up walking through. You don't need all those things, just to be clear. You could do it all with one. I know people who just went all in on dividends. It's completely doable. It just takes a certain amount of time and a plan. But even covering 10% of your monthly cost changes the math, because every dollar of income is a dollar you no longer have to withdraw. In the book, I show the equation of how every percentage that you cover of your monthly costs through cash flow is less money that you have to worry about earning and saving in your actual accounts. So it's a seesaw. And the more you put into the income bucket, the less you need to save, the faster you can be done, and the more peace of mind you can have. And notice what Tim did right, because he did get this part right. He bought that first park while still working 3 days a week as a nurse. He built while the paycheck was still coming in. That is the correct order. And it's the order I use as well. If there's one thing to take away from today's conversation, let it be this. Wealth is what you own, but freedom is what pays you. Assets can make an owner, but only income makes the work optional. I'd love to hear from you. If you left your job next month, what is the one income stream that would pay you first? Email me at contact@escapetheclock.com or leave a comment wherever you listen. I'm Daniel C. Rogers. Thanks for listening, and best of luck building that paycheck that replaces your job and escaping the clock. I'll see you next week.